Trump or Harris? Who should I vote for, Amanda? If I'm a real estate investor and all I care about is my tax policies, who should I be voting for next week?
Well, first off, I'm not going to tell anyone who to vote for. We're all adults here and we all make our own decision. Like Mauricio said, we're not going to get into any of the bad political stuff. We're going to talk about the facts. But let's face it, right? I think people think that there's a clear and simple answer when we ask who should we vote for as real estate investors. Trump is a real estate guy. He favors the wealthy people. Real estate investors are wealthy. Kamala Harris wants to tax the wealthy. So real estate people don't like that because real estate people are wealthy, right? But it's not as simple as that. And here are the reasons why, okay? Because you really have to look at each candidate and what type of policies they favor. What are they going to try to change and how are they going to try to affect that change in reality based on what they've done in the past, what they said in the past, what they've tried to get through Congress in the past. Also, again, it's not as clear cut as what you might think, is the term real estate investor itself is pretty generic. What I mean by that is not all real estate investors are wealthy, right? And not all real estate investors are high income people. In fact, a lot of our real estate investor clients have wealth, but they pay very, very little to no taxes. So for tax purposes, they're like low income, right? And you also have people who are high income earners, someone working in tech, someone who's a doctor who also invests in real estate on the side as well. So doesn't mean everyone as real estate investors should support Trump because, he comes from real estate, he favors the wealthy. Maybe not. I think we're going to get into some of the details of what is on each person's wish list. And I want to emphasize that word wish list because that's really what it is at this point in time. Nothing is a proposal. We don't know what's going to change. And also when we talk about the word real estate too, here's something to keep in mind. Real estate itself is a generic term. Because if you're a real estate developer, certain things on the wish list might be better for you than if you're someone who's a syndicator, right? Only rental real estate. So we're going to have to get into all the details of, what they're talking about to really then arrive at who would I want to vote for? Again, just looking at taxes, even though there's a lot of things outside of that. And if you really look at their wish list, I think you'll maybe be surprised at what you see in terms of what they're talking about.
You mentioned something very interesting that I sometimes struggle with, which is you see a lot of these proposals that want to increase taxes or decrease taxes for people making over a certain amount of money. I think these days it's $400,000 is one threshold, or maybe $1 million. Is that gross? Is that gross income for people, or is it after I take all my deductions? Because to your point, a lot of real estate investors are, at least on their tax returns, are broke. In fact, Trump loses money every year because of his real estate. So what number am I looking for when I see somebody saying, I want to lower my taxes, anybody making over 400 grand? What does that mean, making over 400 grand?
It means whatever you want it to mean, right? It depends on what ultimately comes out in the law. But for the most part, right, generally speaking, when we talk about income, they're looking at adjusted gross income, which is, like basically all of your income minus any business real estate expenses. And that's why I was saying, we talk about taxing high income people or, giving benefits to lower income people. A lot of our clients in real estate make a lot of money, but they are considered low income, which means like they get a lot of these credits that you think like a traditional lower income person would get. But yeah, I mean, there's different parts of the law where the definition of certain things are a little bit different when we define what income is. But usually when we talk about income threshold for tax purposes, you're looking at adjusted gross income. For any of you who are like tax nerds, really want to get into it, typically, when you look at your 1040 personal tax return, you'll see a line called adjusted gross income.
No, I want to be one of those nerds because does anybody make, I guess where I was thinking about the other day is like, does anybody really make over $1 million in income when it comes to figuring out your taxes? Or, I mean, unless you're a high earning CEO or something, I mean, who owns over $1 million? Like everybody just gets everything gets deducted, right?
I think you might be surprised. You have, especially in places like California and New York, a lot of people make $1 million. Even, I mean, we had We have a couple of clients who are like in their 20s, early 30s that make over $1 million working in tech, right? With their salary plus all the stocks. So those people are paying a lot in taxes because most of that is just coming from W-2. So again, that's what I was saying. Like when we say, is this tax policy good for me as a real estate investor? It's different if I'm a full-time investor where I'm getting all the depreciation and I have all the write-offs and almost no income versus somebody, a physician who also invests in real estate, right? Because we have very different tax profiles.
So speaking of wish lists, let's start with bonus depreciation, because I know that's probably one of the bigger ones, I think, for real estate investors specifically. Earlier this year, the House of Representatives overwhelmingly passed not only the bringing back 100% bonus depreciation, but making it retroactive for a couple of years. And I think it was something like 357 to 70. So something like that. It was a crazy vote. And then the Senate obviously, or not obviously, but the Senate shot it down a couple of months ago. Any of these candidates more prone to bringing back the bonus depreciation? And if it does come back, do you think it'll be retroactive?
Yeah, that's a really great question. The whole for most of 2024, we were really anxiously awaiting the bringing back of bonus depreciation. And that was such an unfortunate example because, like you said, it passed with overwhelming majority vote. But also, it was a policy that both Democrats and Republicans really were for, right? Everybody wanted it to pass. Ultimately, ended up not passing, and the narrative was, well, because they didn't want the Democrats to have a win during this election year. So they said, well, instead of just giving everybody something good, let's play politics and kind of do a takeaway. But yeah, I think from the Trump side, obviously very pro business, pro depreciation. So they have signaled bringing back of bonus depreciation to 100%. Now, whether that will be retroactive or not, I think is a little bit harder question to answer. Earlier in this year when we were during 2024 and before 2023 taxes were filed, it would have been an easy way, even in that proposal, to bring back 100% and have it be retroactive, because then we just treat it as if nothing ever changed. But now after 23 returns been filed, we're just currently moving forward with, okay, this year it's going to be 60% and kind of going down. But yeah, I mean, there is still a good likelihood that will come back. Now, whether it's going to be retroactive or not, that's going to be a big question.
And you did mention the wish list thing, and that's an important point. Hopefully, I'm not oversimplifying it, but we've got to remember that the presidential whoever becomes president, the president doesn't make the laws, right? So let's get that civic lesson or a civic reminder. It's Congress that actually makes the laws. Now, obviously, the president can veto a law if they don't like it, and it can be overridden. But at the end of the day, who ends up controlling Congress as a whole, I think would also have a big say into any of these policies go by. Because even if somebody like Trump wins and wants to bring back bonus depreciation and have it retroactive to the 1930s, it doesn't matter unless they can pass it in Congress. And so if the Congress is controlled by the opposite party, it's just going to make a difference. So I love the way that you said this is more of a wish list than anything else, right? It's kind of an alignment of policies that you're really voting for.
Yeah, for sure. And it's really important. Yeah, you're exactly right, because we can have the elected president that has all the wish list items that will be the best for you. But if we have a Congress that doesn't agree, which we've seen in the past, right? Then nothing changes, or it's very difficult to get things to change. And sometimes what happens is we can get a tax change, but it's only temporary, kind of like the Tax Cuts and Jobs Act that we currently have, right? Those are sunsetting as early as the end of next year. A lot of people aren't talking about that. Like even for us today, we're talking about what are the wish lists, what are the potentials, but I think it's also important to talk about what are the facts, like what do we know is for sure going to happen, even if no tax changes occur, and that is tax rates are going up after the end of next year. A lot of the breaks we currently have for real estate investors and business owners are going to be gone. So whether there's an extension of those tax benefits or not is also something, really important for us to keep in mind as well.
Is the end of the 1031 exchange finally here?
Yeah. Well, okay. The funniest thing about 1031 exchange, if you go back and look at previous years, previous elections, it is something that's always on the chopping block, always being discussed, right? But you know, before previously, we could actually 1031 exchange things beyond rental real estate. So for example, like nobody talks about this, but you could have 1031 exchange cars, like bought a car so that you could 1031 exchange. And so a couple of years ago, they took that away. So now current law is we can only do 1031 exchange with respect to real estate assets. So yeah, no, there's all like from I think it was part of President Biden's budget to not eliminate, but reduce 1031 exchange benefit where you can only exchange up to I think the first $500,000 worth of game and then the rest becomes taxable. Now to be clear, that was not a Kamala Harris agenda. However, you know, they're part of the same party. So I would think that if there were something that would be introduced, you know, her part, you know, her and her campaign probably would be more supportive of that than someone from the Trump campaign. But you know, if I had to guess, what is the likelihood of something like that passing? Probably not super high. It's not, you know, the threat of 1031 exchange being taken away or limited, you know, or limited is just something, it's kind of like a fear we live with all the time, every time there's an election. But so far that really hasn't, we really haven't seen that come to fruition with
Why is
respect
that
to
though,
real
Amanda? Because
estate at
you know,
least.
the argument is, you know, there's so much money that is saved through 1031 exchanges that wouldn't that just free up a
Mm,
ton of tax revenue if that went away?
yeah. You know, I think you have to be, I mean, this is way above my pay grade, but there are very smart people who look at all of the proposed policies and kind of see what the economic impact might be. But I think just for me as an investor, right, what I would think is if I could sell my real estate and I can trade up to other properties and I don't have to pay taxes on it, I'm more open to doing that, right? It's something I've done all the time. But if now it's going to change where I'm going to have to pay a lot of taxes when I make that move, then I think more sellers would be hesitant to sell. And we know that, you know, the baby boomer generation owns a lot of real estate. And we already have a shortage of real estate for like new home buyers and all that. So if we're saying, hey, we're going to tax you, those of you who own the real estate forever and ever, then I feel like there's a, you know, there's a disincentive to sell. And I don't know that that actually helps, right? What we're trying to accomplish, we're trying to get more younger people to own homes. I think what will happen, for me at least, is if I was older and I own real estate forever, now they're going to start taxing me if I sell. I'm just going to hold it till death. Because when I do that, when I pass away, I will get step up basis, which means it goes to my heirs and my beneficiaries without anyone having to pay tax. So then there's very little incentive for me to sell before I pass away.
Yeah, and I'm going to go with Todd's question. Let's open it up a
We
little
have
bit.
so many questions.
I know, but I want to stay on kind of on. I want to stay a little bit more focused on the Trump things. But if we can get some tax questions answered as well, and this has to do with the 1031 exchanges on the international front. So speaking of the 1031s, when you sell an investment property in another country, like say Mexico, and pay the capital gains tax in Mexico, do you have to pay capital gains tax here in the States, or can you 1031 exchange?
Oh, great question. So US taxes worldwide income of our residents. For any of you who don't know that, so if you are a US resident, I don't really care where you make your money, it is taxable in the US. Now, if you also paid tax in a foreign country, depending on what country it is, we might have foreign tax credits, so you might not have to like pay double the tax. But yes, you can do 1031 exchange with respect to foreign properties as well. But here's the rule. If you sell a US property, you have to 1031 exchange with US real estate. So if you're selling a foreign property, you also have to replace with foreign real estate too. So yeah, certainly possible to do it at least under current law.
Do you think the installment sale trust is that a kind of an alternative to 1031s? I know Kenneth was suggesting that as maybe an alternative to 1031 if it goes away.
Yeah, I mean, so installment sale is something that, you know, traditionally have been used by investors, right? You call installment sale, seller financing, similar terms. Basically, what we're saying is we're going to sell a property. And instead of paying tax on everything, we'll carry back the note. And so what I'm doing is I'm deferring my capital gains tax over the life of the note. So as the buyer pays me, I will pay some taxes on the money I receive. I'll also generate some income as well. And we actually see a lot. I know people talk about creative financing real estate, um, usually like subject to and things like that, but we actually see a lot of seller financing in the recent years. And I think a lot of that is because you have people who've owned real estate for a long, long time, and now they're just sick of being landlords. And so they don't want to deal with that anymore. However, if they were to just sell it outright, they're going to pay a bunch of taxes on the gain unless they do 1031, right? But if they don't want to do that because they're out of real estate, they want to be out of real estate. If they got this cash, they're probably not going to put in the stock market because you're talking about landlords who've owned real estate like their whole lives. So real estate is still like a safe place for them. And that's where you see a lot where like, hey, they want to get out, but they'll do seller financing. And it's a really great opportunity for buyers coming in, from that perspective. But neither candidate has talked about anything with respect to like that level of detail, like, oh, how are we going to, tax it differently if it's an installment sale or anything like that. But I think some things I thought was really interesting was that, for Kamala Harris, one of the things that she talked about was assistance for first-time home buyers.
Yeah,
You
talk
probably
about
heard about
that.
that in the news. I think that's a really interesting one, right? For real estate investors. So $25,000 down as an assistance for first-time home buyers. And I think the purchase price, she was saying up to 700,000 or 750, something like that. So
Yeah,
pretty
so
high, pretty high purchase price. Is not just like a small condo that they're able to do assistance on. And then there's something about more assistance. So beyond the $25,000, even better assistance for somebody who's like a first generation homeowner. So like, hey, if your parents or grandparents never own home, then you get, excuse me, an even better assistant for that. So, the question really becomes for you as a taxpayer investor, is that something you could benefit from or not? And the answer will differ for a lot of people, right? I think one of the things that people talk about is, if you were to provide this housing assistance, then there would be more demand for purchases. And we already have a lot of demand and not enough supply. So, if you're someone who's new in the market, looking to buy your first home, then this is a great thing for you. If you're someone who already owns real estate, then that might also be good for you because higher demand, lower supply means the value of your assets will probably go up. But I just don't know if that's actually gonna fix the housing crisis if we continue to have higher demand and lowered supplies.
I think I think both of these candidates' policies are all pretty inflationary at the end of the day. So
Yeah.
that's always good for real estate investors. So um, there's a couple questions about capital gains tax since it's kind of relates a little bit to 1031 exchanges. But unless you are a buy and hold forever real estate investor, at some point you're going to have to either sell or 1031, I guess. Talk about the capital gains tax proposals from each party because I know they've got different theories behind that.
Yeah, I mean, so for current capital gains is 15% for most people. If you have higher income, it's 20%. I think one of the things that Kamala Harris has talked about was increasing that to 28% for those making over $1 million. I know previously Biden had discussed a 35% capital gains tax rate. But he's not running, so hopefully that's not something that we're going to talk about again. But yeah, so 28% from 20% for those making over $1 million is going to be higher than what we would like. And I think you have to look at tax changes holistically as well, right? So what I mean by that is if we're going to be able to continue to have 1031 exchange, then maybe we care less about capital gains on sale of real estate because it doesn't impact me. I'm going to 1031 until death, get step up basis, and all that's going to be great. But alternatively, if both of those wish list items come true, then we might be in a situation where, again, it's going to be very difficult for you to convince me to sell because not only am I not going to be able to 1031 exchange completely like I could before, but also my gain, I'm paying much higher capital gains taxes than what I otherwise would be doing. right? So it's funny because when we talk about tax strategy, that's what I mainly work with clients on is tax strategy. And I love talking about strategy stacking. Like, okay, here's a strategy, like depreciation, right? That's a great strategy. And then we take bonus depreciation on top of it. So now it's like even better. And then we take, write-offs. So now we have all these write-offs and pay no tax. So this is kind of like the reverse, right? What I guess we call tax stacking. So we take away some benefits, then we increase the rate on what else you have to pay, and now overall your taxes are significantly higher. But yeah, with respect to 1031 exchange, just to be clear, I mean, we are talking about real estate here, but capital gains tax also applies to stocks, crypto, sale of a business. So those are things to take into consideration too.
Yeah, I mean, I'm just imagining a
Mhm.
world where 1031 exchanges go away and your capital gains tax goes up to 28%. I mean, that would have a tremendous impact on real estate, period. You can figure out which direction it goes. Curtis is asking something specifically about the installment sales trust that we were talking about, but talk about the depreciation recapture, because that's something that's interesting in and of itself. So when you do 1031 exchange and eventually, oh, I'm sorry, it's more about I'm sorry, that's more on the bonus depreciation. Let me take that back. Sorry, that's bonus depreciation. So talk about the depreciation recapture when you take bonus depreciation. How does that affect the bonus depreciation? And also, Curtis, specifically with ISTs, would that still be resulting in depreciation recapture when they sell through an IST?
Yeah, whenever you sell property, if you've taken depreciation on it, there's generally going to be depreciation recapture. The only time when there's no recapture is if you're doing a 1031 exchange, right? Because we're delaying that down the road, or if there's no gain. And unfortunately, we've seen that too, right? So if we sell property, there's no gain, then there's nothing to recapture. But recapture, I mean, a lot of people tend to, make it sound really scary, but recapture really at the heart of it is just saying, hey, you bought a property for $100,000. You have already written off $25,000 of it. So when you sell, you're not going to get to write off that $25,000 again, right? So your gain is going to be the sales price minus 75,000, whatever you have left. So that's really, what we're looking at. There have been talks about, depreciation recapture. So part of that would be at ordinary rates. The other part could be at 25% recapture rate. But there were talks about maybe just recapturing everything at ordinary tax rate. So it's a little bit detrimental, right? Because right now we're playing the numbers game of when I take a write-off, I'm writing it off at ordinary rates, and then recapture, I get it. I'm paying back taxes at a little bit of a lower rate. But there could be a potential change where now it's just the true benefit is just like, the time value of money, right? Get a deduction today, pay taxes down the road if there's not going to be any lowered recapture rate treatment. I think what's really interesting, one thing, I don't know if you guys have seen this for real estate investors. I had to write down the name because it was so long. So there was an act called Stop Predatory Investing Act that was introduced in July 2023. Have you heard of this one, Mauricio?
Yeah, that's the one that they're trying to nail. I think it's geared towards sort of the Black Rocks or Blackstones that are going out and buying, thousands of units. But it obviously doesn't just limit it to those guys.
Yeah, so it was so no interest deduction or depreciation for those who own 50 plus single family homes. So that was such an interesting thing. But I think, like you said, they're trying to get after those large companies to say, hey, I don't want you gobbling up all the single family homes. But you have investors like regular investors. You probably have syndicators who are planning on owning a lot of those homes and sending them operating them as rental real estate. If you think about our inability to take mortgage interest and depreciation, those are like the two largest tax write-offs, right? When it comes to real estate, that could be very problematic. But again, these are just wish list things. But the question becomes, what is the definition of those who own 50 plus? Is it like an LLC? Is it part of like a holding company? Is it just like, my syndication versus another syndication I'm only a little bit involved in? That's where it kind of gets really messy, right? When it comes to here's a wish list item, how do we actually implement and enforce it when it comes to deploying something like that?
And on the recapture, though, isn't another argument too that, especially if you sell it 3 or 4 years, there's actual real depreciation that's happened. I mean, your fixtures have been depreciating over the last 5 years, and so the capture isn't 100% because some of your stuff actually has It's not like a phantom depreciation, which is what most most of the real estate is. It's actually literally your carpets are now worth less than they were when you bought them brand new.
Yeah, I mean, the whole concept of depreciation is to allow you to put a number to those things, right? So why are we allowed to take depreciation? Because the IRS feels like there's going to be wear and tear on the building. So that's why you're allowed to write it off over time. But what we all love about that is regardless of whether the value is actually going down or not, we're still taking depreciation nonetheless. I think one thing that we really should be looking at as real estate investors, and for those of you who are business owners, is the qualified business income deduction. Currently, or in the last couple years, we had the ability, or we currently still have it, the ability where the first 20% or up to the first 20% of business income could be tax free. So, like if you're let's say you're a realtor or property manager and you made $100,000, right? Under this qualified business income deduction, you're potentially not paying taxes on $20,000 of it. And that was really favorable. I mean, it's not just for real estate, it's all types of businesses. But real estate is one of those businesses that we get to benefit from. So we have a lot of clients who are real estate brokers, real estate agents, property management companies, who, when this first became enacted, they're like, wow, this is great. I just get to write off 20% of my net profit off the top. That is something that is sunsetting as of the end of next year. So when it comes to the candidates, that was something that was that Trump does favor, is continuing to allow or extend this tax benefit. Haven't really seen anything from Harris campaign in terms of whether that's something they'll favor or not.
Well, they're his tax cuts, right?
Yep, those are his tax cuts. And so that's a really great example of how we're talking earlier about, when it's not just about the president, but it's about Congress too. And a lot of these benefits, like bonus depreciation, people ask me, like, why do we have it go down? Why was it like 180 and 60? Why make it all complicated like that? And why does this, qualified business go away? And it's because if we don't have, there are only certain things that could be done when you don't have everybody in agreement. So some of these ended up being temporary tax cuts because we couldn't get everybody on board to make these things permanent.
One thing, by the way, just I wanted you to address too, because on the bonus depreciation, as it's been phased out, right? 100%, 80, 60, I think next, I don't know where we are now, 60 or 40.
40.
That doesn't mean that your depreciation is going away. Like you still get to depreciate the rest. You just don't get to do it all in year one. So if you're down to 40%, you just take, instead of doing it over the 27 and a half years, you do it over the first year. And then the rest of it, the remaining 60% just has to be done over the next 26 and a half years, I guess. So I think that's an important distinction. And people just think, oh, I just lost the depreciation. It's like, no, you still get it. You just don't get to all front load it into year one.
Yeah. Yeah. And it's funny because I have people who say, oh, you know what? Real estate prices will go down because people will stop buying real estate once bonus depreciation goes away. And I feel like that's just like the silliest thing. Historically speaking, we've not always had bonus depreciation. We just take regular depreciation. You can still do accelerated depreciation where you're taking a building and instead of writing it off over 27 years, you're writing it part of that over 5 years, 7 years, and 15 years. So that by itself is also very, very beneficial. So even if bonus depreciation itself goes away, there is still a lot of tax benefits to investing in real estate. And of course, you guys know we're not investing in real estate just for the tax write-off. I mean, you're investing for the cash flow, the appreciation, just the generational wealth that we're building. But I think a lot of people have just been so accustomed to, gosh, when I buy this, I can write off everything. And that's the piece that's, going to be changed.
On the $25,000 cash incentive for the first generation, I think jokingly saying, can I sue my brother for 25K if he buys a house before me? But I think when it's first generation, we're talking about the entire generation, right? But siblings are all equal. It's not, I'm the oldest, I get to buy a property and then my siblings don't, right? It's everybody in that first generation.
That's what I would assume. So if like, I mean, I'm an only child, but if I had, three siblings, I'm assuming we can all use that. But what I really like, so from, we talked about how Trump, is pro the qualified business income deduction, because like you said, that was his deal, right? So obviously extending a lot of those benefits that were put in place that we've been using. One of the things I thought was really good for a lot of our clients is so Harris has said or talked about a neighborhood. I'm looking at my notes to see what these names are actually called. Neighborhood Home Investment Act, and that is to provide a business tax credit for certain kind of like development costs, and then also includes rehab to real estate property. So again, these are wish lists, so we don't have a definition like what is rehab. If I'm just doing improvements, if I remodel a kitchen, do I get a credit? We don't know any of the details to that. But I think that is, something that makes a lot of sense because again, we have a housing crisis. Demand is much higher than supply because either people aren't selling or just people too expensive to buy. So how do we fix that issue is to have more supplies. And so if we have more properties being built, we have properties that are going to be improved on. So that people will, want to live in there again. And to incentivize that type of work through tax credit, I think is going to be really good. So again, is one candidate really good or bad for you? It depends. If you're a builder, developer, well, maybe this type of neighborhood home investment act might be something that's really good for you to consider. Right?
The net investment income tax. This is a tax on rental income. It affects rental income, and that one of the proposals is for that to go up. Right? Can you talk a little bit about the is it NIT or NEAT? How do you pronounce it?
And yeah, I call it NIIT.
Oh,
I don't
I
know
always
the
feel like
short
NIT. I'm
version.
like, is it NIT or
NIT,
NEAT?
NIT or NITE. So net investment income tax. So this is really interesting. So years ago, a couple years ago, whenever we would do tax presentations, we would tell people like, hey, next year we're gonna have this brand new tax. We never had it before, and it's called net investment income tax. And people were so angry. They were so shocked. Like, what? Besides just all the regular income taxes we pay, we have to pay this brand new tax. So yes, now years later, we're just used to it, right? So if you're high income earner, net investment income tax we pay on investment income, stock gains, dividends, also includes rental real estate. So if currently the tax rate is 3.8%. And again, this is on top of income tax or capital gains tax you're already paying on this type of investment income. So part of Harris's wish list was to increase that from 3.8% to 5%. So I think that by itself probably doesn't seem like a whole lot. But keep in mind, this was something brand new just a couple years ago, and we are already looking at increasing it, right? So it's funny we thought, okay, how do we increase tax revenue? Well, takeaways, right? Take away depreciation, bonus depreciation, take away 1031 exchange benefits. We increase tax rates, right? Individual income tax rates, capital gains tax rates. And then we also just invent brand new taxes like the net investment tax a couple years ago. And then we, increase the rates on those as well. So
Is that
lots
is
of
that is
very
that on a certain is that like income tax where it's graduating above, or is it just on the entire amount, or is it just an amount above a certain threshold?
We don't know. I mean, it depends, right? It depends on how they're gonna define what amount will go to 5%, if it's gonna be tiered or it's just gonna increase in totality to 5%. But I was just looking at my notes. I wrote down increased capital gains to 25%, but I also wrote increased capital gains to 28%. So don't quote me on that one on the wish list.
That's all well and good. Let's talk about the last major one that I wanted to talk about, which is one of my pet peeves, but people don't think of it necessarily as a tax, but it really is a tax, and that is tariffs. We're talking about tariffs, and one of the candidates is proposing not increasing tariffs, but like massively increasing tariffs, especially on the country of China. And that
Yes,
person is
60.
Mr. Donald Trump, former President Donald Trump. What's interesting to me, and the reason I think this applies to real estate, is that especially with the home builders, they get a lot of their inventory from China, like whether it's their fixtures,
Mhm.
whether it's electronics, whether it's the flooring, whether it's the whatever. When they're building, they get a lot of a lot of their materials from China. And so an increase in tariffs will just make those more expensive. And then the question becomes, does that just get passed on to the buyer and therefore with higher prices, or do they just find an alternative and go start buying stuff from Mexico or some other country? But let's talk about tariffs, because I think that is a big, I do consider, first of all, do you consider that a tax, or do you consider, how would you categorize tariffs in general?
Yeah, I mean, I do. I consider that a tax that I personally don't like that proposal, or I don't know. I don't know if it's a proposal, it's a wish list item. But yeah, I think it's 20% on imports, and then, like you said, 60% on China. I don't even know. Are we allowed to like specifically target China in terms of different tariffs? I'm assuming we can do whatever we want as a country. But yeah, I think, the issue with that is I think we all know, I was just chatting on Instagram with one of my friends earlier today, just, as property investors, real estate investors, we saw that, when it's more difficult to get materials and stuff from overseas, the cost to build, the cost to rehab was outrageous just a couple of years ago. It's finally, a little bit better. And I do agree that if we, increase the tariffs, it really is gonna, what is that, trickle down economics? It's like trickle down penalties, right? The penalty of the tariff is gonna be passed down to all of us as regular taxpayers. I know we're talking today about real estate specifically, but China and other countries provide us with all sorts of things. So just everyday goods are things that will go up and, like you said, become, a very inflationary time, in addition to what we are already seeing. One of the things I always think about is, and, above my pay grade, but just something I was thinking about is like, instead of punishing imports through tariffs, isn't it better if we just improved the incentives that we have for producing more things, internally in the US, right? Like, can we have better tax credits for tech industry, for R&D, for agriculture? I know there's some already, but can we just make those so appealing that for the next generation growing up, they're like, that's no brainer. I want to do all those things. I want to be able to produce and create these things faster, cheaper, better here. And then I think if we can accomplish that, then naturally we will rely less on foreign countries, and we don't have to have all these tariffs, because at that point we don't really need them for imports, right? But that's neither here nor there.
Amanda
I'm so
Hahn
sorry.
for
It's not a tax
president
thing.
2028. Amanda Hahn for president 2028.
The thing is, though, like what I described as a long-term solution, like we gotta wait a while, right? We have to incentivize what we're doing here, and then we have the people who are gonna do it, and then okay, we're gonna be producing all those things cheaper, better, faster, versus I think just, we're gonna just increase tariff. That could happen real soon, and then we'll immediately see tax revenue come in, right? So I don't know. I think as a country we like to put band-aids on things and claim
And
out
I
a
also
win
think
and
it's a
like
little
move
bit
on.
of punitive, right? I mean, it's specifically targeting sort of as a penalty, not necessarily to incentivize or make us more competitive. Well, before I go into another topic, before I answer in the few remaining moments, maybe some general tax questions from Amanda Hahn, of course. Anything else I missed that you wanted to address on the Harris Trump tax issues that we haven't addressed and we should?
Yeah, I do. I have a whole list of things that I typed up, guys, and we
Well,
just,
I know, but we,
took
there's
over the
only an
show,
hour.
didn't talk
Unless you
about
want
a
to
lot
make
of
this a
them.
2 hour show, there's only so much time we got.
Okay, a couple things I want to talk about that I think is interesting for you guys to know in case you don't already know of Kamala Harris's wish list is a new tax, like what I was called like a standard deduction for small businesses. So I thought that was really interesting because you know how like as individuals we can either take itemized deduction where we write off our mortgage interest and taxes and donations and all that, or we take a standard deduction per person, single, married, or whatever, right? So part of Harris's wish list is to have a standard deduction for businesses. So I thought that was really interesting. Again, no details on who's going to be eligible, what's the dollar amount we're talking about, but I think that's something that might be helpful for small businesses just starting out. If there's like a minimum amount of deductions that they can have against the income, that would be really good. It's kind of similar to the qualified business income deduction, right? That Trump has, with the first 20% you don't have to pay taxes on. But that's like a brand new thing that's, we've not seen that in the past where businesses get a standard deduction. With respect to businesses and I guess also real estate too, one of the things that I'm seeing a lot on the news and on social media is the startup cost. So part of Harris's wish list is to have $50,000 in startup cost expensing for business owners. And I think it's just like a poor job of what the media has done to share this. It is not it's not like a tax credit or anything that they're going to provide. It is just saying, under current law, if you had $50,000 of startup costs, like pre-revenue expenses, you can write off 5,000 of it immediately, and then the rest you amortize it over 15 years. Part of the wish list for Kamala Harris is that you can write off the whole 50,000 immediately. So kind of like a bonus depreciation, if we look at it that way, 100% bonus depreciation where you write it all off immediately. So again, it's not free money. It's money that, you have to spend for the startup, but it is allowing you to take it faster than what the current law is.
That sounds to me like it's ripe for abuse. Like I can start any business tomorrow, and if I know that I could, like, $5,000's not worth it, but 50 grand, I mean, I'm just going to start a poker consulting firm, and I'm going to write off all my travel to Vegas. I could just see like picking a hobby, and I know there's tax things about hobbies and all that stuff, but I mean, I just feel like that's ripe for abuse when it's a significant amount of money, which is 50K, which may be worth me spending some time and some loopholes to try and figure out how do I write off 50K that I would have spent anyway.
Yeah. So instead of just having Premier Law Group, you're going to have Premier Law Group California and Arizona, just all the different entities.
That's right. I could just
Sub-entities.
create brand, although I'm screwed because I think most of the professional corporations get, exempted from all these tax benefits and everything. So I'm trying. What else is,
I don't know. I mean, I think if it were to become true, they probably have, I don't know, the tax, what we call it, controlled group limitations. Like if you control all of them, they're really just one business. So
I thought there was an STR question because that's pretty popular these days. So I
did.
wanted to maybe address STR. It actually ended up being a different question that I'm not. It basically, hey, how can I save taxes? It turned into sort of a very generic. The way you save taxes is you call Amanda Hahn, Keystone CPA, and you hire her to give you some amazing tax strategies from your personal opinion. But STR is they call it the STR loophole. But talk about the short-term rentals, and if you're somebody like, it really is like somebody like me, right? So somebody like me, where I'm a high-income professional. I can't qualify for a real estate professional status, and my wife doesn't want to do it. So it's like I'm screwed there. One of the ways that I can start, it's really a strategy to be able to offset taxes against my active income. Because the problem I have is I can go invest in passive, but unless I've got enough passive income, I can't use them. I mean, I defer them.
Yeah.
So talk about the short-term rental idea of how to use short-term rentals as really more of a business and use that to offset your active income versus the passive.
Yeah, that's a great question. So short-term rental, we call it a loophole because in traditional long-term rental real estate, for you to use real estate losses against your non-real estate income, like Mauricio's legal work income, you or your spouse have to be a real estate professional. We can talk for 8 hours about what is a real estate professional, so many rules around that, but effectively you have to spend more time in real estate than your job, which is difficult if you work full-time or you have a spouse and you both work full-time. When it comes to investing in short-term rentals like Airbnbs, you don't have to be a real estate professional. You could keep your full-time job, and even if real estate is just your side hustle, you could potentially use short-term rental tax losses that we create to offset against your W-2 or other business income you have. All you have to do is meet material participation hours requirements. And I have a lot of information on that. If you don't already follow me on Instagram as Amanda Hahn CPA, or you can go to my YouTube channel, I have a lot of information on that, or keystonecpa.com. I have a whole ebook about what is material participation, how do you qualify for it. But effectively, who should care about short-term rental loophole is someone who works full-time, or married couple both working full-time. you want to invest in real estate or you do invest in real estate, but that's just your side hustle, like that's not your full-time thing, then look into this loophole. Of course, you have to want to invest in short-term rentals and do all the Airbnb type of things.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.